Welcome to the Leadership in Land podcast, where we talk about what actually moves the needle in a land business. This show isn't about get-rich-quick schemes or magic mail pieces. It's about leadership, systems, decision-making, the stuff you figure out after your third or fourth pricing mistake, or maybe your first "this deal looked great on paper" moment. Tune in with me in the episode today, and let's dive right in.
You're listening to the RE Tipster Podcast Network.
Okay, so quick question for you. Have you heard of our Skool community? I just want to make sure to invite you to check that out. If you're listening to this episode, it's actually kind of old, to be honest with you. And so if you want our latest, if you want our greatest content we're putting out, real conversations about leadership, decision-making, building a land business that actually works in the real world, get inside our Skool community where you get access to the free leadership course, plus bonus episodes, discussions, and insights that honestly just don't make it onto the podcast. So if you're serious about this, you want to learn more about leadership, get in the community, check it out, leadershipinland.com or skool.com/leadershipinland. All right, let's get in the episode. Hello, friends. Welcome back to another episode of Leadership in Land. I am your host, Dave Deniston of Generation Family Properties and the Land UnConference. So today, what I wanted to spend a little bit of time on was opening up the curtain, showing you behind our business. We've talked deals here recently. We've talked some of the projections and things that we were looking at in the prior year. But I wanted to share with you what happened the first 3 months of the year for us, which I'll show the numbers here very, very shortly. If I was to sum up kind of how I felt about Q1, I would say things are going okay. You know, they're certainly not gangbusters. They're certainly not horrible. It's okay. But with no further ado, let me share a little bit behind our numbers for this particular quarter. So let me share the broad overview first. So first off, big thing, we did not hit our quarterly goal bonus. Every quarter, we're trying to shoot for an average of $50,000 a month cash flow, which basically what that needs to mean is that we're selling properties and we're selling them relatively quickly. As we look at this particular quarter, we have a lot of properties that we bought, some properties that we bought in 2024 that have just been hanging on, that we just need to sell. And we have other properties we bought in 2025, early 2025, where now hard money loans have been due. And we haven't sold them yet. We're holding on to some of these properties a year. And so we gotta pay some of those hard money loans. So what's interesting as you look at some of our numbers here, January, we had 182K of revenue, February, 233, March, 284. I mean, good numbers for a lot of different people. You'll notice that the actual cash flow was pretty steady, 22K positive in Jan, 24K positive in February. But even though we had our highest revenue month in March, we had the worst cash flow of the year. But every month, cash flow is positive. Now, a few caveats here as you look at this particular list. So the revenue that I talked about is actual cash that comes into our bank account. This is not hypothetical revenue based on a note sale of what we think we might get. This is actual revenue. So if we got a $500 down payment, that's what we call. We don't call a whole $4,500 sales price. We call what actually came into our bank account as revenue. If we get partner dollars or hard money dollars, that doesn't count as revenue. Those things get pushed into a different category. Expenses, this is a category that includes payroll. So I pay myself $5,500 a month, plus we have a 401k, so there's a 401k match. Those things are all included as expenses. So certainly you could back out my compensation if you wanted to of what I'm paying myself, including the 401k, which would bump this up by about another $6,000 a month. something like that. So if you want to do an apples to apples comparison, if you're looking at yourself and what that looks like. The other things that get included within the expenses would be if there's any marketing dollars, any partner payments go out there. So if we did an equity split with a partner, that money that we pay them goes out. Certainly commissions to our employees, property taxes that we pay, stuff like that all gets thrown into that expense category. So it's all inclusive, the cash that we had to do to operate the business. What doesn't get included in expenses are things like interest. So if you look at our expenses here, that was about 112K, 156K, and 123K. And what I get as a proxy, which is not an accounting measure, all right, the idea of earnings before interest and taxes, being that this is our earnings. If you take revenue, subtract expenses, that gives us a number. Now, what this doesn't include are things like interest. It doesn't include the payments we make on hard money loans if we're paying principal. It doesn't include if we've gotten a partner to fund a property that we bought. Those things are not included. We also do not include property purchases, which essentially are assets, right? So if we're buying an asset, yes, that impacts cash flow, but that doesn't impact our actual earnings. It impacts our earnings hypothetically when you actually sell a property, right? You get positive or negative. So, but at the end of the day, to me, cash flow is king, which is why after you subtract all of that stuff, whether you've bought property, whether you've spent money on staff, whether you've paid interest, whatever that is, the cash flow number to me is the true thing. Revenue is good to track. Expenses are good to track. What you've bought in land is all good to track. But to me, what gives your business value is what you bring home at the end of the day. So that's why for us, we had about $52,000 of positive cash flow in this quarter, which we did do a distribution a couple of times. I think we distributed out most of that money to me and my partner. Something else interesting here as you look at this, obviously we had some purchases. So in February, one of the things that we did, put about $200K within our first major minor split. So we did a subdivide in Door County, Wisconsin. All in was about $300K we had to put in. We also got about $275K in owner financing. We had an equity partner that put in $100K, whereas within my partner and myself, we put in $200K. So $575 total purchase price, which we think we could sell within a year and a half, all four of those lots, which we hope could generate $900,000 to $1 million of revenue. So we really achieved one of our major goals in Q1, which one of the rocks was, let's get a subdivide purchased. So that's awesome. And so that large amount of money was for that. And then obviously we had some other purchases. We bought another $16,000 worth of land in January, another $20,000 worth of land in March. So a total of $235K went into land in Q1. So if we continued that, that would be about $1 million, little shy of $1 million in purchases, which reality is we could do more. Now, that's just cash out of our pockets. I wasn't including what the partner brought. I wasn't including the owner financing. So technically, we could increase those numbers a little bit, but what I'm tracking here is just cash out of our actual pockets. So that's what happened in Q1. So total revenue, $700K, just about. Total expenses, of those core expenses, about $390K. Total land bought, about $235K. What I call the EBIT number was about $310K, with actual cash flow to us of about $52,000 for the whole quarter, or about $17,000 a month. So not shabby. It's okay. We're doing all right. We'd be doing great if we had $50,000 a quarter. We'd be doing great and on track of our goals if we averaged, what were we hoping to average per month revenue? About $333,000 a month revenue, which would have been about $1 million in Q1. So we fell short. We really fell short of our goals. And right this minute, I see some possibilities that could get us there in Q2, but we really need some of our bigger properties to sell. We need one of our Arizona ag land to sell. We need our main property to sell. We need some Idaho properties we have, which is a total of 500 grand right there to sell. If we could sell one of the minor splits that we have, there's very good reason to think, if not two, in Q2, since they're now on market, that it could happen. Some of the other stuff that I personally headed up was messy title. So I made hundreds of phone calls every month, about 661 calls I made personally, cold calling different people to try and acquire houses. And guess what? We did acquire one, which is on market. Partnered with my good buddy Ajay Sharma. Shout out to Ajay, who helped navigate through that process. As a matter of fact, we have a messy title deal as well, which is a possibility that we could end up selling it maybe this quarter as well. But frankly, I'd count on that for next quarter. What's happening there is when that property sells, Ajay put up the money for that. So we'll get 50% of whatever the profit is on it, which we're all in for about 25K. It's on the market for 100K. We thought it was going to sell for 120. So we did have to lower expectations a little bit because the house was messier and uglier than originally thought. But there is some interest in it and some possibilities. So we'll see what happens. But that would be additional cash flow, which literally cost us nothing. So I'm hoping, we get 25 to 35,000 from that sale in this quarter. So hopefully we can do it again and get another major acquisition in messy title, as well as we're planning on enrolling in a coaching program. And so we're looking at something that's going to cost $15,000 up front, and then we'd have to split proceeds 50-50 of deals, which I'd want help with trying to figure out, okay, what's all the paperwork? Is this a good deal, bad deal? Going through that kind of stuff that I've been through with Ajay in Q1 here for our first. So if we can get 1 or 2 deals under our belt in Q2, that could really help give us momentum to end the year well. And as we get that proof of concept, then the next thing that we're going to be doing is hiring people, with the first one being an acquisitions manager. I hate making those cold calls. I really do not enjoy it, but I'm willing to do it in order to help us get to the goal. So we're going to be looking at that, spending some money on marketing. We've done a little bit of mailing here and there, but my list is getting bigger and bigger and bigger for people to contact, which will then help, of course, our acquisition manager who ends up tackling this. So hopefully by the end of this quarter, we're really moving strong on that. Going into Q3, which then the messy title portion hopefully gets bigger and bigger and bigger. And hopefully we land another subdivide this quarter or an entitlement project of some sort, which then gives us more and more momentum going into the rest of the year. So I'm hopeful, and we'll see what happens. Now I want to show you a little bit on March, which was our highest revenue month. If you take a look at how this was dispersed in terms of revenue, we had a $40,000 cash sale here, a $33,000 cash sale, $1,000 cash sale, and we had a down payment for about 10 grand. So those 4 sales made up 26, 58, about close to $100,000 came from cash sales from medium-sized properties, as we like to call them. So what was great month, obviously, for cash sales, we have even more potentially in April that could be coming through, going with what we see seasonally, March, April, May being some of our strongest months of the year. And then June, July, August kind of not being as good, and then ramping up again, September, October, maybe November timeframe. So we're charging forward with that. Now you notice one of the categories that I have here was debt servicing. So while we had great revenue, I also paid off $123,000 in debt, whether it was principal or interest, which most of that being principal. As a matter of fact, most of these sales we just talked about, guess what, had to pay off some hard money loans. One of the other things that you'll notice here that we did, we put about $17,000 into tax liens. So one of the things that I do as ways to acquire property, at least in the past, is I've acquired a lot of tax liens. And so what happens is as you move to foreclosure, you end up having to get trued up on maybe future property taxes that need to get paid, as well as potentially if you didn't endorse every single year, you might have endorsements you have to make up plus the foreclosure costs. So that was a big cash flow expense as well in the month of March. Plus we had about $29,000 of property purchases and about $13,000 positive coming in from partners. So we put a lot of money into land purchases, tax liens, and then debt servicing related stuff last month. Otherwise, cash flow would have been awesome. So obviously, if we just shut down most everything, we'd have incredible cash flow. Let's just say we didn't buy land or liens. Well, that would be about $46,000 more in cash flow that we would have in our pockets. So every day is different. Every day is interesting. As I mentioned earlier with debt servicing, particular category, we did have to pay off some hard money loans that came due. I think that was about 50 grand out of the 122 were ones that had come due. And I could have chosen to keep on paying interest, but given that we haven't sold them within a year, I don't want bad money to good money to chase bad money in the future. So took the pain, which again, that cash flow could have been that much better if I didn't pay that off. But we have that policy as something hits a year or very close to a year, let's pay those suckers off. So I'm hopeful as we go forward that those kinds of things aren't going to be a major issue for the business. And this is certainly that classic argument of, do you use your own money? Do you use equity from partners? Do you use debt servicing? As I crunched the numbers in this most recent quarter, honestly, it was about a break even either way. If we had had an equity partner, we would have paid about the same on those cash sales as we did with debt servicing based on the property. We thought it would sell for $55,000, but we actually sold it for $40,000. If we had sold it for 55 or 50 or 45, we would have much further ahead on debt. But in this current environment we're in right now, where margins have at least for us, have gotten relatively thinner, it's definitely a break even in a lot of cases. Certainly if we make a mistake on a property, then that debt servicing component has hurt us and will hurt us with some of those properties that you'll hear Cameron and I talking about in a future podcast. So that, my friends, is what's happened for us in Q1. I'd love to hear what's happening for you in Q1. How are things setting up for you in Q2? What are you seeing in the business? What lessons are you learning along the way? I'd love to hear from you. Make a comment in our Skool community or send me an email, dave@genfamland.com. Appreciate you. Talk to you later. Bye-bye. All right, well, that wraps up today's episode. If this was helpful, don't just let it live in your head. Take one idea from today and actually put it in practice. That, my friends, is where the real progress happens. And if you want to check out and keep the conversation going with people, you want to check out a bunch of free resources and talk about the challenges we all go through, please come and check out our Leadership in Land community on Skool. We got bonus content, real discussions, and a free leadership course. No hype required at all. Check out leadershipinland.com or go to Skool, Skool.com/leadershipinland. Appreciate you being here. Talk soon.